Welcome to the Return on Lifestyle podcast with Rey Descalso from Privada Wealth Management. In this podcast, we help you overcome financial worries and make sense of planning, investing, insurance, and banking. Join us for this journey as Rey draws from his expertise and interviews brilliant minds to help you enjoy life. The best is yet to come.
Hello and welcome to Return on Lifestyle with Rey Descalso from Privada Wealth Management. Today we're going to be talking about stability planning, and I'm just going to bring Rey right in because I've got a quick question for him about stability planning. Good morning, Rey. How are you?
I'm doing well, sir. How are you?
Doing great. I know we're well into 2019. How are things going in the business in your world?
So far, so good, and the weather is absolutely gorgeous here in Central Florida. This is why we live here, not because of the hurricanes. We don't enjoy those, but the day like today without a cloud in the sky and about 60 degrees, wonderful.
Well, that sounds fantastic. How far are you from a beach?
I'm about 45-minute drive from the closest beach. Yeah.
That's beautiful.
Yeah, it's fun.
Oh, goodness. Yeah, I think I'm, at this point, 17 hours from a beach. All right. So you sent me some notes about today's podcast. I'm excited to get into it. And I'm reading stability planning, and the stability planning has a little trademark symbol next to it. Why is that?
You know, I took the time to go and submit stability planning, the phrase, as a trademark approach to financial planning. And so I've got that as a brand, and I've got that as a system that is unique to our practice here.
That's
and
great.
What I've done is, I've taken what I've learned over the years and the very best practices of financial planning and honed them down to what I think is very appropriate to my clients. And I've also created some things that are unique to stability planning as well.
Great. All right. So where are we going to be starting today with stability planning?
I like to start with one of those unique things, and it's called the 4 factors.
Right. I think everybody could use stability planning just as a general term. I could use a little bit more stability in my financial life and different parts of my life. That'd be great. And when we spoke about financial landmines in previous podcasts, you painted a pretty grim picture of what people are facing when they're planning for retirement or they're currently in retirement. So how does stability planning work for folks that are looking to retire or currently in retirement right now?
So one of the things we have to do is we have to make sure that we understand ourselves. That's what the financial landmines were about, knowing where you are. It's kind of like what Mike Tyson said, the great philosopher, Mike Tyson.
Oh, yes.
He said, everyone has a plan until they get punched in the mouth. And so stability planning is having something that is non-emotional, something that's on paper, something that you've got that you can rely on when life or the markets or Congress or the Federal Reserve, when something punches you in the mouth. So understanding yourself and then understanding your tools. And today I'd like to talk to you about one of those tools, and it's something that I call the 4 factors and how we should look at our money through the 4 factors.
Okay. And so what are those 4 factors and why do they, or how do they play into this scenario?
Sure. The 4 factors it's a term that I've coined, and I did it over years of working with clients. What I came up with is I realized that when we speak with clients about their money and what they're able to invest in, we're always talking about 1 or 2 aspects of their investments. And I wanted for them to take a look at the big picture. So let me give you kind of an example. I'm a doctor's kid, and so I grew up in a medical community, and a lot of the analogies that I'll lean on come from that, being surrounded by that. And one of those things is when you go to a doctor, a test that they'll run is called a CBC, complete blood cell count.
Okay.
And what they do is they look at your blood they look at everything. So they look at your red blood cells, they look at your white blood cells, they look at platelets, and why do they do that? And there's other things too. But this is not a medical podcast. I'm not a doctor. I'm not recommending a CBC to anybody. I have no clue why you would do it. But what I do know is that they look at the red blood cells because they're like, hey, that lets us know where we're at as far as oxygen goes. And it can, a lack of could mean that there's some other issues we need to investigate. White blood cells, I think you've heard of that before. It talks about infection. If your white blood cell count's really high, possibly you've got something going on. And then platelets tend to refer to and tend to allude to your clotting factors. And that's a concern for doctors if those are out of whack. So a CBC runs at least 3, probably more aspects of your blood. That's the way I like to take a look at when it comes to people's investments. I want to take a look at the four factors, and I want to make sure that my clients understand not just what the four factors are, but how they interact. So let me share with you what the four factors are.
Okay.
And then we'll review them, and we'll break them down, that kind of thing. So the four factors are the characteristics of an investment pertaining to its liquidity potential,
Okay.
volatility potential, growth/yield potential, and fee potential. And I use the word potential because there is not a yes/no answer. It's a sliding scale. So liquidity, volatility, growth and yield, and then finally fees. Those are the four factors. And they matter because almost every investment available to you should be analyzed by looking at each of the four factors, not one or two, but each of them. And they also matter because if we overlook one factor, we could very easily be disappointed in the future. You know, I would say the analogy would be like if you're trying to pick a team for the NFL draft. You know, you don't pick all the biggest guys just because they're huge, 350 pounds and can bench press a Buick. That wouldn't make any sense. I don't know if you've ever seen Tom Brady, but Tom Brady looks kind of like just a normal spindly dude. He's not 300 pounds because he's not a lineman. He has a specific job to do.
Yeah.
He's not particularly fast. He's not particularly big. He is very handsome. A little jealous about that, but hey, what are you going to do? He has a role to play, right? Yep. And that role is quarterback, and he's got his giftedness, if you will. And so your investments, building a portfolio, you need to take a look at all the factors, not just the size of the player. Okay, so don't just look at fees, for instance. Look at the entire picture of what an investment does, what it can do, what its potential are across all four factors.
Gotcha. So when we talk about the four factors, the first one was liquidity potential. Can you break them each down for us so we understand a little bit a clearer picture? And let's start with liquidity potential. I'm interested about that one.
Yeah, let's start there because it's the easiest one to understand. This is the ability that you have to turn an investment into liquid cash. So an example of very, very high liquidity potential would be a money market mutual fund. Okay. A money market mutual fund, historically, they've had high liquidity potential. In other words, if you look at your money market fund, it's a mutual fund that historically and by mandate and by prospectus is supposed to keep that $1 value forever and ever, and also have a very tiny yield. On the opposite end of the spectrum would be something like a non-traded real estate investment trust. And I want to stop here and just say, I'm not recommending any one particular security to anybody. I want to just describe generalities here, just so we're clear. And I'm also not disparaging money market mutual funds or any of the investments we talk about. I want to give some definitions looking through that lens. So as I mentioned, on the opposite end of the spectrum of liquidity would be a non-traded real estate investment trust. These are investments where there is no secondary market. There's no place for you to say, okay, I think I'd like to go ahead and sell that. I wonder what the price is today for me to exit into cash. It's held for an indeterminate amount of time, and your liquidity is locked up. So it's a very low liquidity potential.
Yeah.
And that's one factor to look at both of those different types of positions.
Got it. Yeah. It sounds a little scary to be in something like that because you said it could be locked up for how long?
Well, that's just it. We don't necessarily know. The people who are running the real estate investment trust, they don't necessarily want to keep your money forever, but they also have to be able to exit it themselves as they're getting all of this real estate bought up and put out there. So if you ever look at a real estate investment trust's prospectus, it is very, very, very long with lots of lists of bad things that could happen to you. And well, it should be. And liquidity potential being very low is one of the big issues that you have to discuss with your financial advisor. So yeah, it's very scary, but that's one of the factors. The other one that I think it'll probably relate really well, especially as we're recording this here in January of 2019, is volatility, the potential for volatility that an investment has, right? And I think we know what that means. It's the potential variation in value that an investment can have over time. So, a fancy way of saying it is statistical dispersion of returns as measured by standard deviation. Okay, that's whatever. Basically, what it means is when I take my daughter to Disney World, we rode the Barnstormer, right? The hills and valleys on that roller coaster were pretty good. I'm not going to lie. I enjoyed it, but it was made for my 5-year-old daughter. It's not quite like I don't even know. I think the worst one's probably Space Mountain, where it's completely dark and you're going 60 miles an hour. That volatility is much greater. And that's one of the reasons why I keep talking about potential and I keep talking about historically, is because number one, we don't know. We use the modern portfolio theory to help shape those kind of things when it comes to standard deviation and when it comes to volatility.
Got it.
So we've got liquidity, we've got volatility, we understand what that is. And then of course, why do we do all this? Growth/yield. And that one's easy. That's what, that's why we invested in the first place. We wanted either our investment to grow in value or to produce a yield, an income for us. And so investments have a track performance, and this track record helps us with our expectation towards reward and risk. And we can go back to, when it comes to different variations on that, we can go back to that small cap stock, the stock you've never heard of, itty bitty, it's only worth $10 or whatever on the stock exchange. That particular stock could have a greater potential for volatility, but also volatility can be good. It can be going up. That's a good thing. If you look at something like a money market fund, we don't really look at much in the way of growth potential in a money market fund. That's not why we invest. And so there's risk and reward. The reward from that small cap stock could very well be very high, but so is the risk. And of course, you've got your risk being very low with a money market fund, and your returns match that. So liquidity, volatility, growth yield. So I say growth yield because growth is when the net asset value, kind of like when a house simply sells for more tomorrow than it did today, that's the growth. The yield is, say, a dividend or a coupon or some sort of income stream that comes out of it. In the analogy, it would be like rental payments from that same property. And so I don't know which one necessarily we're looking at for each investment, sometimes both. So I say growth and yield potential.
All right, Ray, we've done 3. We've got liquid potential, volatility potential, growth yield potential, and I know the 4th one is fee potential. What is fee potential all about?
Well, fees are the price that you pay to invest. And this is one that lately has become a really big topic. A couple of years ago, the Department of Labor came out and they wanted to make sure that fees were fair and that fees were in line with helping out all of the investors out there. And I think that's a very worthy cause, and it created a hot debate. But something else has kind of happened that I think is interesting about fees is it is a topic where everybody is kind of obsessing on fees, almost to a fault. And I'll get to that in a second. But fees are the price that you pay to invest. And the example I would say would be realtor commissions, for instance. So an investment that you can make is real estate. When you go to buy real estate, a lot of folks don't realize that there are fees in real estate. And let me break that down. My father came to me and he asked me, do you think that investing in real estate is a good investment? And one of the things I told him, I said, well, you have to look at everything. And a lot of times folks aren't really looking at fees. So realtor commissions are a really easy fee to see. Okay, we've got those realtor commissions. But also too, you're going to have other fees. Let's say it's going to be a rental property. Then you have long-term, you may have a management company that takes a bit of what's coming in as far as the income. You also have taxes. You may have overhead expenses that per the lease that you have with your tenants that you're taking care of, whether it be improvements to the building and repairs. So fees are complicated and need to really be looked at to make sure we understand what we're talking about. Another kind of fee that's easy to understand in the investment world would be management fees in mutual funds. The question you have to ask yourself is, are these fees getting me what I'm paying for? In other words, are they really delivering on what they?
Is it worth it?
Is it worth it? Yeah,
that's
it. That's it. So, and the reason that's key is because over the last few years, as I alluded before, as the market has climbed, everybody has realized that an S&P 500 fund, index fund, has very low fees. In a bull market, when the market's going up like it has ever since 2009. I think we're going to be okay if we just buy, this is the thought people have too many times, just buy the cheapest thing you can get because everything's going up. Well, that's where, unfortunately, I think the tail wags the dog, where the quest for low fees, we're not looking at the bigger picture. When I talk to people about that, the analogy that I use, and I think it's important, is, where my office is located, I am equidistant to a Cracker Barrel and a Ruth's Chris Steakhouse. Now, have you ever been to a Cracker Barrel before?
Oh, yes.
Oh, good. So you've been to Cracker Barrel, fantastic experience. You walk in. Every time I go to one, it's crowded. They're trying to sell you tchotchkes on the way in, and the menu is just good down-home cooking. And I don't know if you know this, but they actually have steak on the menu. Have you ever had a Cracker Barrel steak?
No, just usually it's a biscuits and gravy. I love
right. That's
biscuits
kind of what they're not known for their steak.
Yeah.
I had their steak. It was $9.99 at the time that I got it. And you know what it tasted like? It tasted exactly like a $9.99 steak. I'm not saying that to disparage Cracker Barrel. I'm not saying that in a bad kind of way, but it was not bad and not great. Now, down the road, equidistant in the other direction, is a Ruth's Chris Steakhouse. Now, have you been to a Ruth's Chris Steakhouse?
I have not.
Okay. So here's what they do at Ruth's Chris Steakhouse. And I could be wrong on the exact science of how it all works, but what they do is they get you a big old hunk of meat that is prime, which basically is a genetic mutation in the cow that makes it super fat. And so that's a real fatty piece of meat. And then they stick it in a room for 30 days, or maybe it's 28 days, doesn't matter, a long time. And it just gets old and funky. And as it ages, like fine wine, then you go in there and you buy the steak and they put it in the grill to your temperature liking. And they put it on a plate too. And the plate's got a little bit of butter on it. And it's like, 110 degree plate. So the butter's sizzling as they bring you the steak. It's a whole production. And they tell you this whole story too, by the way. Now, why do they create this amazing experience and tell you this long story? Because the steak is $45.
Holy cow.
Yeah. Well, it depends on which one you get, but let's just, one of the ones that I did have once, $45. And I was like, wow, this better change my life. You know what I'm saying? This experience, it better be worth it. And so the issue then is not, was either one of those steaks good or bad, but did the quality, did the experience, did the outcome match the price? And oftentimes when people look at fees, they look at all four factors, because it is the efficiency and the utility of the investment, not necessarily the expense. The other thing I'll say about fees too is, and I kind of alluded to in the real estate, keep digging, because I've had a lot of folks come to me saying, well, my 401k is free. No, there's fees inside your 401k. Or they'll talk about how there's no fees in their fixed indexed annuity. Well, yes and no. Let's take a look and see how the insurance companies are able to extract money from you in lieu of a stated fee. And you do that by looking at the four factors. So that's an overview of the four factors: liquidity, volatility, growth, and fees.
Got it. So I have to ask the question, was the second steak worth it? Right? I mean, that's what we're talking about. Was it worth it?
Yeah, it was. It was. And let me tell you why. It was worth it, because it was a great steak. It tasted fantastic, smelled wonderful and everything. But it really was not necessarily the slab of meat. It was the overall experience. It was that, the feel that they gave you. So it would be kind of like going to a Broadway production, versus listening to a CD on the radio. There's just something special about the regalia and so forth. And it was good. I will say though, now what I do is I split it right down the middle, and I buy a $9.99 steak from Costco and grill it at home.
There you go.
And it's better than both Cracker Barrel. I hate to brag. I mean, this is my podcast. I guess I can brag about my steak.
Go for it.
Yeah, why not? I mean, that's really why people are tuning in here. They don't care about four factors. They want to know about how to cook a good steak.
That's
maybe
right.
That'll be a podcast.
That might be a podcast, because you and I could talk about that quite a bit. I've got some connections here in Nebraska, which is pretty much all beef and corn. So yeah, we can cook up some steak.
Let's talk. Let's talk offline.
Sounds good. All right. So we've gone over these four factors, and you've given opinions on each one and just a little bit of snippets, but really, why do you think that they are that important to take into account?
Yeah, great question on that. The reason it's so important to take into account the four factors is because, number one, we tend to focus on one at the expense of the other three. And I mentioned fees because everybody talks about fees, but another good one would be growth. Everybody's like, oh, this is the hot stock. But what they don't look at is volatility.
Yeah.
So there's always this trade-off, and no one seems to, I shouldn't say no one, people often get blinded. So when you hear about a fixed index annuity that has no fees, well, then what is it missing? Well, the fees are non-existent. I don't see any fee coming out. Okay, that sounds really good. The growth in yield, well, they're not great, but historically we can expect X, Y, and Z, usually anywhere from 3 to 7%, depending on who you talk to and claims that they make. So what am I giving up here then? Well, let's talk about liquidity. You put your money in here, Mr. and Mrs. Client. They want to keep your money for 10 years. And if you try to take it back, they'll hit you with a fee, essentially, called a surrender charge. And so you gave up liquidity to get stability, lack of volatility inside the fixed index annuity, and to have low fee potential. And so this bartering system, I'm not recommending and I'm not disparaging. What I'm trying to explain to folks is there is this barter system where investments tend to excel at one at the expense of the other. And so when you go to diversify your portfolio, typically you think, well, I want some small cap, I want some emerging markets, I want some, internet, like we're at a salad bar, and we just want to pick up all these different parts of the pie chart. I would hold out to you that diversification then should not just be in that modern portfolio theory asset allocation, but you should be looking at multiple types of investments based upon the 4 factors and diversifying by way of your fees, diversifying by way of your growth potential, which asset allocation does that to some degree. Your liquidity, I think you should have some liquidity, and I think you should be willing to let go of some liquidity. Okay. And by doing that and bartering with that, you have a more robust portfolio. And that barter system, as people start to understand it, they start to realize, hey, this is a good deal. Let me give you a few examples. Often we focus on, one factor, and one big one is always fees. In the early 2000s, variable annuities had these guaranteed income riders, and they provided very attractive guaranteed yields on your pension in the future. And they guaranteed a pension in the future that was a pretty good payout. But the fees were so high that many clients found themselves stuck. So everybody was so excited about growth in yield. They signed on the paperwork, and they come back in, 2011 and 12 after, having been in there 7 years, and they realize, hey, my pension is going to give me pension, values $200,000, and it'll create, $12,000 in income for the rest of my life. But if I wanted to walk away here, this is only worth $150,000, $120,000. The fees and the lack of performance had actually diminished what they had because they weren't looking at fees in this case. That happened in the early 2000s. That's a way for folks to realize that you have to always have your eyes open.
Yeah.
And as I mentioned before, if we can diversify by all 4 factors, then what we'll find is we'll find a more robust portfolio. If all of your wealth, for instance, is in real estate, treasury, and 30-year treasury bonds, you've got good growth potential. Real estate has got a good track record, but you've got major liquidity issues. Real estate and individual bonds can be very expensive to liquidate. And so I meet a lot of folks who they believe in one thing and they believe in one strategy, and that can cost you down the road. Go ahead.
I was going to say, I think a lot of this comes back to kind of what we've talked about on previous podcasts a bit, which is emotions and feelings. Because if I'm looking at these 4, liquidity potential, if it's not a very liquid asset, then there could be some fear there. Well, what if I need it? The fee potential, that's a bad feeling. Oh, look at this is going to have high fees, but we're not taking other things into consideration. Volatility potential. It could be volatile, so I'm kind of scared of that thought, right? Or the growth and yield potential, that's where we can get a little greedy and say, well, I really want everything to grow rapidly, so this is what I want to invest in because this is going up right now. And I think a lot of it has to come back to people need to be working with somebody or have somebody walk alongside them that is kind of the no man when you go to buy a car. They can tell you, wait a second, this is not what you need. This is what you came here for. You got to stop looking at the $150,000 sports car. You got to get that minivan because that's what you need right now. So I think that it's so important to have somebody walk beside you in this that can say, okay, let's take a look at all these different things. And like you said, a little of column A, a little B, a little bit of C, and a little bit of D, because diversifying that way really balances everything out. And then you don't have to have that fear, or you don't have to succumb to the greed, or you don't have to worry about whether you're going to need it, because you'll have some that's going to be more liquid than others. And that makes for a pretty good plan.
Yeah. Yeah. It is another way to look at diversification. And the reality is the reason we diversify is because there is no one investment. I get phone calls, I get from folks who come to me and they'll say, all I'm looking for is something that'll give me about a 7% return, guaranteed, no fees, and completely liquid.
Oh, yeah.
And I'm like, oh, okay.
Let me know when you find that.
Right. I will continue to look, because again, you get to pick a couple of these, but you don't get all four in one super investment.
Exactly.
What you do is you diversify, and you find, like you said, you find what works for you right now. What is the next thing to add to your football team? What is it to add to your basket of tools? Because you don't know what the markets and what life is going to deal you, and you want to have all those tools in your toolbox.
Absolutely. Thank you, Ray, so much. This has been great. Do you have any closing thoughts for us today?
Just stick with the plan. Everybody's got a plan till they get punched in the mouth. Just stick to the plan.
All right. Bob and weave, baby. Bob and weave. All right. And thank you all for listening to the Return on Lifestyle podcast with Rey Descalso. If you have not subscribed to the podcast yet, please click the subscribe now button below. This way, when Ray comes out with a new podcast, it'll show up directly on your listening device. It also makes it much easier to share these with your friends and family. Again, thanks for listening today. For everyone at Privada Wealth Management, this is Eric Johnson reminding you to live your best day every day. We'll see you next time.
Thank you for listening to the Return on Lifestyle podcast. Click the subscribe button below to be notified when new episodes become available. Posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Privada Wealth Management. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider for any questions you may have regarding your investment planning. The following program is sponsored by Privada Wealth Management, which is solely responsible for its content. Securities offered through J.W. Cole, financial member FINRA SIPC. Investment advice advisors are unaffiliated entities. The opinions expressed by Rey Descalso should not be construed as specific investment, legal, or tax advice. All economic and performance information is historical and not indicative of future results. Investing may involve the risk of loss of principal. Any tax advice on this show is not intended to be used by any person for the purpose of avoiding U.S. federal or state tax penalties that may be imposed on such person, and each listener should seek advice from their tax advisor or legal counsel on topics that arise from the show. Rey Descalso is not providing legal or tax advice. Nothing should be construed as solicitation of an offer to buy securities. The preceding program is sponsored by Privada Wealth Management, which is solely responsible for its content.